I don't even know if he's going to answer now. He's probably using it as an excuse. Oops. Get the right number, Sean.
What excuse?
I'll tell you in a minute.
Your call has been forwarded to voicemail. The person you're trying to reach is not a. Your call has been forwarded to voicemail. The person you're trying to reach is not available. At the tone, please record your message. When you have finished recording, you may hang up.
Hi, Alan. This is Sean Simpson. Looks like I had you on the schedule here to go over an IUL. Just to refresh your memory, this is an index universal life policy that leaves a legacy to your family. And this is what the wealthy have been using for years to grow their money tax free with no risk of market loss. Anyways, I wanted to give you a call. I'm sorry, I have about 20 appointments a day, and I'm running a little bit behind on appointments. So I do apologize. I do want to provide you the customer service that I hope you're used to. I'll send you a link to reschedule. If this is something you're not interested in, just type back not interested. If it is something that you're interested in, go ahead and schedule a time that works for you, and we'll see if we can connect, and I'll go over it with you. The next appointment is usually about 15 to 30 minutes. Uh, I would ask that you give me about a 15 to 30-minute window because I do run a little bit late sometimes, as you know. But I look forward to meeting you, and I look forward to helping you, and I hope you're having a wonderful day, Ellen. Bye now. So that guy, so I double book all of my appointments.
Mm, yeah.
And because I got a lot of leads coming in and some of them do no show, so I just double book them. And every once in a while you get a crabby ass, pardon my French. And
Good week.
and
Good.
so so I always let them know if I'm running late. I just send them a text and I'll say, look, I'm finishing up with a client. I'll be with you in just a moment. And then sometimes, if it's 10, 15 minutes, then my dialers jump in and they're like, hey, this is Ian, Sean's assistant. I want to help you reschedule. And he
Nice.
said, man, I think I'll pass, but thanks for reaching out. Sean is clearly too busy to provide the personal customer service that I'm used to. Have a great rest of your week.
I
So,
like that one. And that's why I got to ask you, Sean, why would you leave such a long message?
because for one, I want to remind them, listen to the key points that I left on the message, though, right?
Mhm.
And that's the purpose of it, is the key points that I leave on the message. It's not that it's a long message, it's the key points reminding them that this is an IUL, it's an index universal life policy. It's just another chance to give them a little nugget to say, hey, maybe I do need that instead of just not showing up. And also, I can let them know at that point in time, build a little posture and let them know at that point in time that I may be running a little bit late. Why? Because I have a ton of appointments, right? And why do I have a ton of appointments? Because I'm the guy that you need to talk to. I'm the guy that builds IUL successfully, right? And people want to be able to go to that guy that they know, like, and trust, right? If you're busy, that means other people are getting helped by you. And so the long message that I leave is really important because they hear that the index universal life policy can leave a legacy to their family. It can grow money without any risk of market loss, And this is what the wealthy have been using for years to grow their money tax free. And everybody wants to keep up with the Joneses. Everybody wants to grow their money like the wealthy, right? And so then usually I'll let them know that, hey, pick a time that's going to fit you. And if you can't make the appointment next time, just let me know. Send me a text, shoot me an email, or give me a call. You have all three forms of communication, right? So, Balraj, you made it. I promised you last time that I would go over another call with you to explain how an IUL works.
Yeah.
Okay. So what I'm going to do is share my screen. I'm going to run financial inventory, and I'm going to do a call exactly like I would do a call with a regular client, like the one I just got off the phone with.
All right.
Now, this guy that I was running late by, if he answered the phone, I was actually going to run it live on here with you guys, so you guys know. But that didn't happen, obviously. Okay. So let me share my screen here. Hang on, give me a second.
Now, even though it's a few minutes late, would you attempt to call him again?
Yeah, I just did. I was a half an hour late. Yeah, that was the one. So I was double booked for 12:30 my time. And so I talked to the one guy because I had two appointments. I talked to the one guy, and then the second guy was the one I just called just now. All right. Can you guys see my screen? No? Yes, no?
No, it's still loading.
Oh, it's loading on your side.
Yeah, it says Sean Simpson.
Jeff, you sound like crap, my friend. You got a cold going on or what?
Yeah, I'm in bed.
Okay.
Excuse me, man. Yeah, I'm in bad shape.
I'm sorry to hear that.
Well,
me
I
try
didn't
this.
want to miss this though, you know. I'll go on mute because I'm coughing.
Okay. My phone is connected. Come on, Zoom. All right. Now can you guys see it? Yes, no, maybe so.
No, yes.
Yes.
Yes, okay, I see it. Okay, cool.
Sean, can I ask you a
Awesome.
question?
Yeah.
Yeah, Sean, when you do your presentation, I've heard you do it both ways. Do you usually start out with the inventory and then go into it, or do you start out with explaining the IUL first?
I have been using the inventory first. I'm going to go right into that right now. That's what we're going to do.
Wow. Cool.
Yeah.
Okay.
So that way, if they don't qualify, I'm not wasting more time. I'm going to try to put them into a final expense policy right away. So who wants to be my client? Balraj, you want to be my client?
Yeah. Okay.
All right. So usually I'll have this stuff filled out right here. And let's say your birthday is 5/29/1979. Okay. So that makes you what? 24 minus 1979. Whoops. 45, right?
Okay.
Okay. So ring ring.
Hello.
Yeah. Balraj, this is Sean Simpson. How are you?
I'm doing good.
Fantastic. I got you on the schedule here to go over an IUL with you. Is that correct?
Yeah. IUL. Yeah. I want you to know
Yes.
more about it.
Perfect. So time out. If you guys have any questions, we're going to go right through this. If you have any questions, write them on your piece of paper and then I'll answer them at the end. But we're
Okay.
just going to go right through this whole thing. Okay. So you want to know more about it? Okay, perfect. So usually this call takes about 15 to 30 minutes. I like to call it a discovery call because you're going to discover how an IUL works. And I'm going to discover some things about you. As you probably may or may not know, you can't just go buy this type of coverage. You have to qualify for it. So I'm going to ask you some finance questions. I'm going to ask you some medical questions. From there, we'll reschedule at that point in time. And that next appointment is actually the fun appointment because I'm going to show you, I'm going to share my screen with you and show you how much money you can have in retirement, when you can borrow from it, how much you could borrow from at what given point in time, all based off of current market values. Does that sound fair enough?
Yeah, that sounds good.
Okay. So I got your birthday here as 5/29/1979. Is that correct?
Yes.
Okay, perfect. What's your height and weight?
5'11",
Okay.
170.
And then you're 170. Okay. Any tobacco products in the last 5 years?
No,
Okay. And then are you married, single, divorced, widowed?
single.
Okay. And then let me ask you something. What got you interested in an IUL? Let me rephrase that. What do you want the IUL to do for you?
So I wanted to retire peacefully, but with also guarantee like a tax-free kind of income towards my retirement. I just saw this ad and that's why I wanted to know about it. So I just have a
Okay.
basic information of IUL where on the ad it showed that you can have tax-free retirement, and that's what
Okay.
intrigued my interest into it.
Okay. Now, do you have any type of life insurance product right now?
Yeah, I just have a basic whole life.
Oh, you do. What do you mean by basic whole life?
Like it's a $100,000 of a death benefit.
100,000 on the death benefit?
Yeah,
Okay. And what is that for?
that's for for my family gift, which I want to leave behind when I pass away.
Okay. So that's just something to leave behind, like a legacy.
Yeah,
Okay. And then do you know the name of the carrier that you have it with?
it's Mutual of Omaha.
Okay. So why are you looking for more life insurance? Is it just for the tax-free retirement, or are you wanting to leave more behind to your family?
Just for the retirement for myself.
Okay. Now, so you're wanting to build for retirement. Do you have what kind of assets do you have that acts as life insurance, like a 401k, IRA, stocks, bonds, mutual funds, CDs, anything that would go to a beneficiary when you die?
I just have a 401k from my job.
Okay. And
Yeah,
how
and
much do you have there?
I have about close to 90,000 in it.
9,000?
90, yeah.
Oh, 90,000.
Yeah.
Okay. And do you think that's enough to live off of in by the time you retire in 20 years?
Not really,
Okay. Why not?
because the taxes are going up and the rate of
Okay.
inflation. So that's why I
Taxes going
wanted.
up,
Yeah.
inflation. Okay. How much do you really want to live off of? How much do you need per month to live off of?
I was aiming for about $3,000 to $4,000 a month.
How much are you living off of now?
About 6,000.
About 6,000?
Yeah.
Okay. So you want to go down in income by the time you retire.
Yeah, because my needs will be less, I guess. at the time.
Needs are going to be less. Okay. Can I ask you a couple of questions?
Yeah.
Do you think, looking back 10 years ago, 20 years ago, even, what was the price of eggs and milk and even houses cheaper, or were they more expensive?
They were cheaper.
Okay. So in the next 10 years, maybe 20 years, because you got 20 years left to retire, do you think eggs and milk and houses and even taxes are going to go up, or will they go down?
They'll go up for sure.
Okay. So do you think we'll need more money to live off of?
Yeah.
Okay. I would, my last client, he was talking about how he didn't want to put too much money into his retirement. And I mentioned to him that, we have to pay for our retirement no matter what, right? We can sacrifice a little bit right now to pay for our retirement for the lifestyle that we want to live, or we can sacrifice when we get to retirement by living a lifestyle that we don't want to live, right?
Yeah.
Okay. Do you own your own home right now, or do you rent?
I own it.
Okay. And then how much do you owe on the mortgage?
About 300K.
About 300,000. Okay. And then do you know the value of the house?
Yeah, it's 800.
800,000. So you have about 500,000 of equity there. Most of my clients want to have enough to pay that off if something were to happen to them. Would that be something that you would want as well?
Yes.
Okay. Now, what is your monthly payment?
3,500.
3,500. Okay. And then how many years do you have left to pay on that?
15.
About 15 years.
Yes.
Was that a 30-year mortgage or a 20?
30 year.
Okay. Okay. And then, Balraj, how much do you contribute to savings every month?
About $1,000 a month.
Okay. And then if you were to look in there on any given Wednesday, how much is in the savings account?
Can you repeat it?
Yeah. If you were to look in your savings account on any given Wednesday, how much would you say your average savings account balance would be?
About $2,000.
Okay. So you've only been contributing for about 2 months now since you put 1,000 a month in there?
Yeah.
Okay. All right. And then what's your occupation? What do you do for a living?
Electrician.
Electrician. Okay. And then what does an electrician take home every month? What's your monthly net income?
6,000.
Okay. And that's after taxes. That's what you get to keep, right?
Yeah.
Okay. And then what is your monthly expenses total to be? Like if you were to add up, your mortgage payment, car payment if you have one, gas, insurance, utilities, food, Netflix, credit cards, date night, what would that add up to be?
About 4,500.
4,500. Okay. And that includes the mortgage?
Yeah.
Okay. Do you have any credit card debt?
No, no, no. I don't have any.
Okay. Good for you. And so that leaves, by my math, that leaves about $1,500 extra per month. Does that sound about right?
Yeah.
Okay. Got it. All right. Health questions. What prescription meds are you taking or have taken in the last 12 months that you don't take anymore?
I just have blood pressure pills. Atenol.
Blood pressure. Okay. Which one?
Atenol.
Spell it for me.
AET NOL.
Okay. And then what else?
And then one thyroid medication, levothyroxine.
Levothyroxine. Okay.
That's all.
So just the two meds.
Yes.
Okay. And then when were you diagnosed with thyroid issues and high blood pressure?
It's been 5 years now.
Okay. So you were 40.
Yeah.
Okay. And then any hospitalizations or surgeries in the last 5 years?
No hospitalizations and no surgeries.
Okay. Let me run through these medical conditions to find out if any of these apply to you. And just let me know yes or no. Have you ever had a heart attack, stroke, mini stroke, cancer, any stents put in?
No.
Any diabetes, neuropathy, high blood pressure, lupus, rheumatoid arthritis, asthma, COPD?
Just the high blood pressure. That's all.
Just the high blood pressure? Okay. And then how about any anxiety, depression, kidney or liver disease?
No.
Okay. Any felonies or misdemeanors in the last 10 years?
No.
Okay. Any moving violations in the last 10 years, like speeding tickets, reckless driving, DUIs, suspended licenses, anything like that?
Just one speeding ticket.
On
That's all.
speed? Okay. Do you know when that was?
I was going 70 on a 50 miles zone.
No, what month and year?
Oh, that was like last year, November.
11 of 2024?
Yeah.
Okay. You were trying to be like Speedy Gonzalez, huh?
Yeah.
Okay. But no reckless driving tickets or anything like that.
No reckless driving. Just that one ticket.
Got it. Okay. Well, let me do this. I got some information here from you. Let me kind of go over what an IUL is and what it can do for you, okay?
All right.
Okay. So first and foremost, I always like to explain to my clients that this is a life insurance policy, not an investment, even though there is an investment aspect of it. Okay. And the
Okay.
reason why I distinctly say that is because with an investment, you have the ability to go up and get yourself some gains. And you also have the ability to go down and get yourself some losses and a tax bill. And we want to try to eliminate those latter two through an IUL.
Mhm.
Okay. Now, are you familiar with the 401k? I mean, I know you have one, but are you familiar with how it works?
I just know the basic little bit of that I can only withdraw after 59 and a half years if I don't want any penalties. Is that right? And it just grows. The money which is in the 401k, it grows with the funds that I have that the company has invested in.
Yes, and your company can match you, that kind of thing too. Does your company match you right now?
I guess so. I think they're doing 50-50. Whatever I put in, they put that same amount. I guess.
50. Wow, they're matching you 50%?
I'm not sure about it, but that's what I.
Okay.
Yeah.
Don't feel bad. Most people aren't sure how the 401k works or the fees that they're paying or the amount that the company is matching. So I would recommend that you find out about those so that you know exactly what you're gaining and possibly what you're losing as well. Because you never know when we're going to have a down market. Now, what I'll do here is I'm explaining this. I'll kind of compare it to a 401k. Not that there's anything wrong with a 401k, but I want to make sure that most people are familiar with a 401k over any other investment. So I'll just use that just to kind of compare. Okay. So your IUL will also leave a legacy to your family if something happens to you, meaning that okay, your 401k, let's say you've generated a large lump sum over the course of time, and
Mhm.
if you die, your beneficiary gets whatever's in there. That's it. Whatever's in there. Then they also get a tax bill because since it's deferred tax, somebody has to pay taxes on that. And if they don't roll it over to their own 401k and use that money, then they also get a 10% penalty as well. Okay. With your IUL, once you get approved and you make that first payment, the next day you pass away, your beneficiary gets a substantial death benefit, and that is tax free. It also comes with living benefits if you qualify for them. Okay. Meaning that if you get hurt, sick, injured, you can pull from the death benefit while you're still alive to sustain loss of income. Okay. It also comes from the cash value as well. So, as an example, if you were to get in a car accident and you don't die, if you die, straight life insurance pays off. If you don't die, you're kind of in a heap of trouble. Let's say you're laid up in the hospital for 4 months. Maybe you went into a coma. I have a really good friend of mine that was in a boating accident. He was getting pulled by the boat on a tube. The boat swung around. He went flying off into a rock bank and got injured really bad. His spine detached from his hip. And so he would have qualified for a benefit like this because he was in the hospital for 9 months. So, true story, by the way. And so if that happens, would your boss keep paying you?
No.
Yeah, most people say no, most of my clients. But your IUL will. You can pull from the death benefit to sustain loss of income. If you get hurt, sick, injured, if you get sick, we already went over the hurt part. If you get sick, have a heart attack, stroke, kidney damage, liver damage, kidney damage, cancer, 1 in 2 males in their lifetime will get cancer, 1 in 3 females. That means either you or myself will probably get cancer sometime in our lifetime. If that happens and it's deadly, you can pull from the death benefit to sustain loss of income because your boss will probably wish you well and send you flowers, but they're not going to pay you. And they're definitely not going to pay your doctor bills. Okay.
Yeah.
So, but your IUL loves you and it will pay you. Okay. Now, that's the protection side of the IUL. The mechanics of the IUL work like this. Every month, when you contribute to your IUL, this is the part that's kind of like your 401k. It's insurance, right? So every month just like your health insurance, your car insurance, we make a payment, but I don't like to say payment. I like to say contribute to it. And the reason why is because you're also going to use it to build for your tax-free retirement. And so every month when you do that, or if you make a yearly payment, you can do that too. But every month when you do that, a portion of those funds goes to the cost of insurance, which gives you the death benefits, what gives you the living benefits. It's what makes it a life insurance policy, and it's what protects your family. It's the protection side of your payment. The other side of your payment is what is going to the accumulated cash value account, and that's just a fancy term for saying a savings account. What do they do with that savings account? They index it with the market, not in the market. It's with the market. Okay, let me explain. This is where people get a little bit confused. So your 401ks, IRAs, stocks, bonds, mutual funds, pick one, they're all in the market. As the market goes up, everybody's happy, hunky-dory, living life. When the market drops below zero, cuss words start flying, right? Because we're messing with people's retirements.
Yeah.
Your IUL is different. You participate in the gains, you don't participate in losses. So if the market does 5%, you get 5%. If the market does 7%, you get 7%. But you don't need a high percentage to make a lot of money with this. because it's guaranteed to never lose you money. Let me give you an example. Let's say in your 401k you have 100,000. In your IUL
Yeah.
you have 100,000. And then all of a sudden, we're going to use easy numbers here just to prove a point to do this demonstration. Let's say overnight the market tanks and it drops 50%. Balraj, how much do you have left in your 401k?
50,000.
50,000, correct. How about your IUL?
In the IUL, I guess
Yes.
aren't same with the IUL. Is that right?
Yeah, you'd have 100,000 because you don't lose money, right? So technically, you've
Oh,
already made 50,000 in this example. Now, here's where it gets a bit tricky. The very next year, the market rebounds, goes right back up the same amount that it went down. It goes up 50%. Now, how much do you have in your 401k?
100,000.
No, sir.
How much?
What is 50% of 50,000?
25.
25 plus the 50 that you have in there makes,
So 75,000.
so you'd be at 75,000. That's correct. Now, how about your IUL?
There you will have. So I didn't lose any money in that. So 100, I already had it in there, and then 50% of 150,000. So 150,000.
You'd have 150,000. That's correct. So the whole point, obviously, these numbers are very inflated, right? It's just an example. But the whole point of me doing this example, I do this with every one of my clients. And the reason why is because in both scenarios, the 401k in the IUL, the market did exactly the same thing. It went down and then back up, right? But the only difference
Right.
in the two products is one product never lost any money. Okay.
Yeah.
You know who Warren Buffett is?
Yeah,
Yes.
I've heard of him.
Okay. So do you know Warren Buffett's top two rules of investing?
Yeah, I don't know.
Okay. His number one rule, and you can Google this, his number one rule is never lose any money. His
Mhm.
second rule is always refer back to rule number one. Now, I know it's kind of cliche, right? But why would Warren Buffett, one of the richest guys in the world, one of the top 5 investors of the world, say that his top 2 rules, not number one, but top 2 rules are never lose money, right? He could have just left it at rule number one, don't lose money. But he added another rule that said, go back to number one. That's how important it is. Why? Because he knows that when you lose money, sometimes it takes time and time and time. We never know how much time it's going to take, but sometimes it takes a long time just to rebuild that money back up if you lose money. And here's the reality, we don't always have time. What if you're 62 years old and the market tanks and it goes just like in 2008? Say you were 60 years old in 2008, you had $1 million in there and the market tanked 40% overnight. True story. Now you're down to 600,000 and you're supposed to live off that for the rest of your life. You just gave 400,000 to a down market, right?
Yeah.
So that's why it's important to never lose any money. And so the percentage doesn't matter as long as you're growing. It does matter, but it's not as important as to never lose any money. Now, the other benefit that I like to go over with my clients is the borrowing privileges. Okay. Back to the 401k. Let's say you've generated 100,000 in your 401k and you want to take out a loan and you pull out 75,000 in the form of a loan to put a down payment on a new house, which you can do in a 401k. But it's mandatory that you pay it back unless you're 59 and a half. If you don't, you have to pay your taxes. And if you don't, you pay your 10% penalty as well. Okay. So just to kind of give you an idea of what that looks like, average America is in a 25% tax bracket. And if you 25% of 100,000 is 25 grand.
Right.
And if you don't pay that back, that's another $10,000. And on top of that, that equals about 35,000.
Okay.
Okay.
Can I?
Hold on, Kelly. Let's talk about it at the end. Okay.
Never mind. Okay.
And so with an IUL, same scenario, right? You have 100 grand and you pull out $75,000 to put a down payment on a house. Okay. Now, here's the third reason why the wealthy have been using this for years. Number one is that it's tax free. Number two is that there's no risk of market loss. And number three, even though you've pulled out 75,000, depending on the type of loan that you pull out, you can still accumulate and compound interest on the 100,000 that you've accumulated over time, not even though there's $25,000 left in there. Does that make sense?
Yes.
Perfect. Now, the next step, Balraj, is to schedule another appointment. And at that appointment, I would ask you to be in front of a computer because I'm going to actually share my screen with you. And at this point in time, we're going to run what we call an illustration. And this is going to show you all the numbers. It's going to show you what you could have in retirement based off of the current market values. It'll show you some of the fees. It'll show you, how much you could borrow from, all of that fun stuff. Does that sound fair enough?
Yeah, that sounds fair enough. But I also have a question. Can I roll over my 401k into IUL?
Yes, you can. And we can get into that in the next call. Absolutely.
Okay.
Okay. It depends on how old you are on the process. And I know you're 45 right now, but the answer is yes. And so there is a process of doing that, and we can definitely go over that. And if you're watching this video and you don't know, reach out to me and I'll go over that process and let you know how to do that. But okay, so back into it. So before we reschedule, Balraj, I need to know two numbers from you. Okay. And why do I need to know two numbers? Because this is a flexible product. You don't have to make the same payment every single month. You're encouraged to do so, and that's going to be the best outcome for you, but you don't have to. Okay. So and the cool part about this is not like a term policy where you call me up and say, hey, Sean, how much I need a $500,000 worth of coverage. How much is it going to be? And I tell you, it's going to be, whatever it may be. This is more along the lines of how much you want to contribute to your tax-free retirement and the lifestyle that you want to live when you get there. So most of my clients put in 1,000 to 1,500. I have clients that put in 3,000. I have clients that put in $5,000 a month. I have clients that put in 50 grand a month, right? So what I want you to think about is 11 months out of the year when things aren't going so well. Let me rephrase that. When things are going well and you're making really good money, all your bills are paid, what is the max you would want to contribute to your tax-free retirement? And then on the flip side of that, 1 month out of the year when things are not going so well, what is maybe the wheels are falling off the car, you got some extra repairs. What is the minimum you would want to contribute to your tax-free retirement no matter what?
So the maximum I could contribute is 750,
Okay.
and the minimum I can do is 450.
Okay. So that gives me some good information here. I'm going to use this to do my homework and put something together for you so that I can come to the call and be most efficient for you. So let's do this. Let me look at my calendar here and then let's reschedule. And I would encourage you to allocate about an hour of time and be in front of a computer because I'm going to share my screen with you. You can do this on a cell phone, but if you're in front of a computer or an iPad, you're going to be able to see the numbers bigger. Okay. And it's only going to benefit you better. So, what time do you normally get back in the door from work?
Around 6 o'clock in the evening.
Okay, perfect. Now I just go into setting the appointment and I'm done. Simple as
Okay.
that. And I
All right.
allocate about an hour and a half, okay, depending on the client, right? If I feel that they're a client that is asking me a lot of questions, like cutting me off and asking a question here, asking a question here, I know that this first appointment usually takes on average about 15 to 30 minutes. So if I have a client asking a lot of questions and it goes from 45 minutes or an hour, that client is definitely going to ask more questions on the next call. So I may allocate an hour for that, right? But if I have a question or if I have a client that's like, okay, cool, you explained it perfectly and we're done in like a half an hour, I'll maybe allocate an hour, right? Because what I want to do on the next call is draw the illustration and then also fill out the application as well on the same call. Okay. And by the way, guys, I don't know if you heard me on the last call, but if you guys schedule an appointment on my calendar to run the application, or I'm sorry, to run the illustration, if you guys want me to run the illustration and fill out the application, I'm going to split it with all of my agents 99% to 1%. You guys will get 99%, I'll get 1%. Okay. I want you guys to succeed. Okay, does that answer your question, Balraj?
Yes, it does answer it.
Okay, does
Yes, it does.
this help you?
Yeah.
Okay, now I'm going to open it up to questions. I know, Kelly, you had a burning question or a burning comment in your mind. What was on your mind? I didn't mean to cut you off, but I wanted to get through this smoothly. You're muted.
It was better to be muted. I was chewing something. No, you got to the part, and I understand the importance of the IUL and tax-free advantages. And I was talking to a person that came back and said, well, the 401k and the IRA can do the same thing. It's still a tax benefit. And that's the way she approached me.
The
And
401k can do the same thing?
we started off and she, and I was confused where she was coming from. And I have to admit that she kind of ticked me off a little bit.
Okay.
Says, why don't you reach out to Warren Buffett and tell him that?
Sure. Well, first of all, we can't let ourselves get ticked off, right? Because as soon as we get off, that's taking everything down the drain. So, and I'll admit, Kelly, I'm the first one to admit that I have a temper. I've been doing this for a long time. And when somebody ticks me off, what I do is I create space between my comment, right? So I'll just not say anything. And when you leave space, now they're wanting to come back and want to know what you're going to say next, right? And so when I leave space there, that gives me time to breathe, take a deep breath, let it all out. And when I do that, I relax and then I can calmly say something. And actually, I purposely say it slower and I'll ask a question. Okay, I completely understand where you're coming from. Why do you feel that way? What makes you think that? Does that make sense? And that can go, that's generic, right? That can go with anything. Now, as far as the 401k doing the same thing as an IUL,
Not possible.
it doesn't, right? If you die with a 401k, let's say you have 80,000 in there. If you die with a 401k, your beneficiary is going to get 80,000. Now, if they're in a 20% tax bracket times 20%, they're going to pay 16,000 on that 80,000. So they're actually getting less. Okay. Now, if you die with an IUL, let's say they have an accumulated cash value of 80,000. Okay. But their death benefit is 140,000. They're not going to get the 80,000, but they will get the 140,000 from the carrier, and that is tax free. So you're actually leaving, if you want to talk about a return On an $80,000, you're leaving a negative return with the 401k. With an IUL, you're leaving a positive return because they're getting the death benefit instead of the cash value. They're getting whatever's more. And the death benefit is always more. Because otherwise it can't be a life insurance policy if the cash value is higher. And that is tax-free. So they're not only getting a higher amount, but they're not having to pay taxes on that.
Right.
They're not giving Uncle Sam a part of their benefit.
I get it. And where I went the wrong direction. She came back. Well, that's a very one-sided conversation. An IUL versus a 401k or an IRA. And it's like she wanted to get into debate. I'm not here to go into debates. And that's where I got, a little.
Yeah, so what I would do is something like that happens is just say, no problem. I can understand, you like 401ks. Is it okay if I send you some information? And then send her a video about 401ks. If you have Lead Champ Pro, you can do that,
Yeah. Mm-hmm.
So, yeah. Does that answer your question?
Sure. Yep. I'm cool. Good. Thank you.
Any other concerns, questions? Jeff, any questions? Balraj, any other questions?
No.
Yeah. So
no.
how do you roll over for IUL? Like, I don't understand that. Like, I know that was the question, but like, I actually wanted to know.
Okay. So if you're over 59 and a half, all you're going to do, they have to pay taxes no matter what. 401k is a deferred tax program. It's meant that way. The government built it that way. And the whole reason why they built it that way is because a long time ago, when people were living for or working for industries, big industries, they would have these things called pensions. And like the railroad has a pension right now, right? Well, as industries were dying down, they were getting rid of the pensions, and these companies couldn't pay the pensions anymore. And so the government said, well, all of these people are going to retire, and we're going to be in a world of hurt. The whole country is going to be in a world of hurt if these people are turning 65, they want to retire, or they have to retire because they can't work anymore and they don't have a income to live off of. And because Americans need something to live off of, not just Americans, but everybody in the world does, right? Down in Mexico, the older people, they get a little bit of a stipend, but they go to move in with their kids. And so that's why you see a lot of people in other countries living with their big families. So what the government did was they said, okay, we're going to put together this product called a 401k. And we're going to have people manage it, and we're going to pay people to manage it. And that's why there's a lot of fees, okay? And it's invested in the stock market. And those it can go up and make you a lot of money. It can go down and make you no money. So it's developed for a person that is a hard worker. It's the blue collar investment, right? Because you don't need to know how it works, okay? Because there's somebody with the company that's managing it for the people in the company. And a lot of times the company will actually match them. And so it's very attractive. You don't have to know any financing. You don't have to go to school for financing, and you can still make a lot of money, right? Sometimes, unless there's a market drop, then you lose a lot of money, right? And nobody's going to be able to predict when a market drops. Think about 2008. Nobody predicted that. If they did, that would have never happened, right? In 2008, it was the housing market crash. And if you look at the history of the S&P 500, people lost almost 40% in their portfolio in just the S&P index. It was a horrible time, right? Housing market dropped like crazy. There was houses on foreclosure for 2, 3, 4 years, 5 years, sometimes 8 years. My sister was in foreclosure for 3 years before they came to take her house. She didn't make a payment for 3 years. That's how bad it got, because the banks had so much shadow inventory that they didn't even foreclose on people because they had too much foreclosures coming in. They didn't have the money to pay the attorneys to foreclose on these people. It was that bad, right? So the 401k is designed to help people have something in retirement that don't go through the education of learning finances. Okay. Now, so that's why they put these penalties on here, to encourage people not to take them out before they're 59 and a half, before they go to retire. Okay. And so that's why you have to pay your taxes. Now, the reason why you don't pay taxes up front is because the government said we want to, and the theory is like what you said earlier when we were going through the role play, Balraj, we're going to live on a lower income later on down the road, because usually by the time you're 60, 65, your house is paid off. So you don't have a mortgage. You have less bills. You have less expenses. And so because of that, you're in a lower tax bracket. So you're going to pay lower taxes later on down the road when you retire. That's the theory, right? That's why it's deferred tax. That's why there's no taxes up front with the 401k. They take it out of your paycheck before you get it so that you don't have to pay taxes on it. And it goes directly into the 401k before you pay taxes on it. And then when you turn 65 and start taking income from it, that's when the taxes start to come out. Okay. And you only pay taxes on the amount that comes out as income. You don't pay taxes on the whole amount in there. Okay. So as you get a monthly paycheck at the end of the year, that's your now income for the rest of your life. Okay. But the rest of it that you don't take out is still in the 401k, supposedly earning money. But if we have a down market, again, you could be 70 years old pulling money from your 401k, and all of a sudden now you went from 500,000 to 400,000 because we had a down market. You still lost money. Okay. So you can take that out and slowly roll that over into an IUL in short amount of time. You can do it in like a 5-year period. Because if you have a lump sum with an IUL, you don't want to dump it all in there at once. You want to do it over a 5-year period minimum. Okay. Now, if you're below 59 and a half, you can still do that in a 401k. You still have to pay your taxes. Okay. But any other place, any other time, if you're taking money out of the 401k and you don't pay it back, you still have to pay the 10% penalty. You can roll it over into your 401k before you're 59 and a half, but you have to do it over a 10-year period. You have to fill out a form called a T72, and you have to get your accountant involved and sign off on it so that they know what to do, so that they don't charge so the government doesn't charge the 10% penalty. So you can do the same thing as you would when you're 59 and a half, below 59 and a half, but you have to do it through a form called a T72 over a 10-year period. And once you start the process, you can't go back. Okay. So it's complicated. You have to get an accountant involved. And so usually when people do this, they have a large lump sum. They'll pay the taxes on it, but they're not risk averse. They don't want to deal with any risk. They want to be able to sleep at night knowing that the IUL is going to be able to help them and never lose any money. There's no risk of market loss. And that's what those types of people are concerned with. Those are the people that want to use the T72, get it out of the 401k, put it in the IUL. Okay. Some people are like, you know what? I don't see a down market coming, so I'm going to just leave it in the 401k. And that's fine too. Okay. That's why there's extra ramifications. You want to get an accountant involved. That way everything is copacetic. Everything's great for the client. The IRS knows exactly what's going on so that they're not taxed and or they're going to be taxed, but they're not penalized that 10% before they're 59 and a half. Does that make sense?
So before 59 and a half, if I sign the T72, at that time, do I have to pay the penalty or no?
No, you don't have to pay a 10% penalty if you go through the T72 process. But what you're doing is taking money out of your 401k over a 10-year period of time. You can't do it any sooner. You have to do it over a 10-year period of time. And you don't have to pay the 10% penalty, but you do have to pay taxes on it. You always have to pay taxes on your 401k. Always.
Okay.
If you die and it goes to a beneficiary, they have to pay taxes on it. Somebody has to pay taxes on it. Okay. The money that goes into an IUL is already been taxed because that's the money that you've earned. You've paid taxes on that because it became income. And then now you're putting it into a life insurance policy. It's already taxed. Okay. But your gains that you get from the IUL in any other type of investment, that would be taxed as well. But in an IUL, it's not when you pull it out in the form of loans. If you pull it out in the form of withdrawals, then it is taxed because you're telling the company specifically, I don't want to pay it back. But the IULs are designed so that you can take it out in the form of loans so that you don't have to pay taxes on it.
Okay.
That's the whole purpose of it. And when you do take it out in the form of loans, it's supposed to cover you for the rest of your life if it's designed the correct way. That's why you want to be a diligent licensed agent to do your homework on how to design the IULs the correct way. Because if you don't, they could lapse later on down the road.
Okay.
Does that make sense?
Yes.
Okay. We got about 2 minutes left, guys. Any other questions?
No.
No?
So one more question, Sean.
Sure.
So the taxes is on the withdrawals, and how much tax is it from the if we take the withdrawals from the IUL?
Withdrawals, it really all depends on your state, what the state taxes are, what the federal taxes are at that time, what tax bracket you're in. But you're only taxed on your gains. You're not taxed on what you put in there. So if you put in $1,000 a month, and let's say over 10 years, that's 120,000, right? $1,000 a month times 12 months is 12,000 times 10 years, that's 120,000. And let's say over that 10 years, you've made 60,000 in gains, right?
Mm-hmm.
So you got your 120,000, you made 60,000. Now you're at 180,000 of cash value. Okay. You take it all out in a withdrawal, or maybe you take out half of it. Okay.
Yeah.
You're only going to be taxed on the amount that you gained, right? So that portion, that 60,000 that you made, that's what you would be taxed on. And if you took out 30% of that, you could do that.
And the most preferable way to use my money is going to be with the loans. And does NLG provide wash loan? Like, do they credit 2% or something like Transamerica does it? Like they give you 2% credit if there's like a 2% loan interest. Do they do like something like that or no?
2% credit.
Yeah, like after 10 years, if you maintain your IUL for 10 years, and after that you take a loan, for example, if the loan interest is 3%, for example, and NLG they credit you 2% so that your loan interest is 1%.
I don't believe they do. I don't believe NLG does. There are carriers that do that, but I don't believe NLG does. I'm not 100% sure though.
Okay, because Transamerica they do that like after 10 years. If you like maintain your policy after 10 years, you take a loan, they will give you 2% credit. So
yeah, it's like a wash.
Yeah, wash loan. Yeah, so that's okay. NLG doesn't do it. Okay.
But you can call NLG and ask them. They're more than happy to help you.
Okay.
All right, guys. It's just past 2:00. We are all finished up. Next call is on Friday at 11 a.m. Central. Go ahead and jump on paybackteamtraining.com. All right. See you guys tomorrow. Don't miss the team training call at 1 p.m. Central.
Got it.
All right.
Thank you.
All right.
Thank you.
We're going to go over convention stuff. Talk to you guys later. Have a blessed day.
You too.